Basically what he's saying is we've got a forecast, and if that forecast comes true, we can begin dialing back on bond purchases. So let's take a look at the forecast that they have out there. The basic message at the center, a bet on continuing gains in labor markets. Well, unemployment has come down 0.6% over the past year, but only 0.2 since QE3 began. Hasn't moved at all since February. We're creating a lot of jobs now, more than 200,000 on average per month since the start of the year. But other measures of the labor market, well, we're not seeing a big rise in hours worked, suggesting no big pickup in demand that's going to drive more hiring. And the percentage of people who are actually looking for work has fallen since QE started. So a lot's going to depend on how they define progress. And, of course, Jim Bullard this week telling us that he's not convinced quite yet on what they're going to do. Now, part two of the Fed's forecast, moderate growth that picks up in the next several quarters. On that, we have a long way to go. QE3 may have boosted stock and bond prices, but look at GDP. Hasn't done anything for that. It's lower than before it began. Their forecast by the end of the year, the economy will have grown 2.3 to 2.6% since the fourth quarter of last year. So far, we've only grown 0.7% this year. We'll need an enormous pickup to meet their projection, and nobody really thinks that's going to happen. Their final forecast, inflation too low, about a percentage point by their favorite measure, below their target. Well, we got a little bit of good news in that gasoline prices are going up. I can't believe I just said that. But gasoline prices will push up inflation a little bit. The question is for how long and how much it trickles down to the core. So Bernanke now has set up the criteria for dialing back on bond buying, but by their criteria at the moment, they're 0 for 3. So betting on a September tapering, that's a big stretch for Wall Street right now.
Okay.